The Federal Reserve just cut interest rates by 25 basis points. Today, we're going to cover what this means, why the Federal Reserve is so important to not just the US economy, but to the global economy, and what it means for us as investors. And here's the kicker. The Fed meeting where they announced the rate cut was on September 16th and 17th. I'm recording this video on September 14th. So as a bonus, I'm going to walk through how I know the Fed rate cut is going to happen and share with you two tools that you can use to stay ahead of the curve. So without further ado, let's dive in. What's up, everyone? This is Brandon from Wealth Potion. And if you're new here, Wealth Potion is all about teaching you personal finance, investing, macroeconomics, entrepreneurship, all of these really important topics that we generally are not taught in school. And I try to make it super simple and super fun so that you can stay engaged and learn something along the way with the goal of building our wealth. Today, we're talking about one of my favorite topics, the Federal Reserve. And if you're a subscriber of Wealth Potion, you know that we talk about the Federal Reserve pretty often. So the first thing we need to talk about is what is the Federal Reserve and why is it so important? Then we're going to talk more specifically about this interest rate cut and what it means for you and I as investors. And as mentioned, we'll finish off today's video talking about these two tools you can use to see around the corner and see what the Fed might be doing next. First things first, what is the Federal Reserve? The Federal Reserve, or often referred to as the Fed, is the central bank of the United States. In other words, it's the bank for all of the banks. So when you go get a mortgage or a loan from your bank, or when you deposit money into your bank account, your bank uses the central bank as their bank if they need to borrow money or if they need to exchange between other banks. Now, most countries have a central bank of their own. I'm in Canada right now, and Canada has the Bank of Canada. In Korea, where I live, they have the Bank of Korea. And in the United States, it's called the Federal Reserve. So why is the Federal Reserve important not just to the US economy, but the global economy? Well, the short answer is that because the US dollar is the world's reserve currency, a lot of global trade between nations happens using the US dollar. In a kind of unofficial way, the Federal Reserve leads the charge in terms of monetary policy. And as the world's reserve currency, any monetary policy that affects the US dollar is going to have a much more outsized effect on other economies across the globe. So what do I mean by monetary policy? The Federal Reserve has what's called a dual mandate. In other words, they have two official goals. There's a third kind of hidden goal. We're going to talk about that in a future video, so subscribe to Wealth Potion if you want to learn about that. But their two stated goals is to have low unemployment and low inflation. How does the Fed attain these goals? They use what's called monetary policy. And there's a whole bunch of tools in their toolkit, but one of the most powerful tools is their control of interest rates. Now, to be clear, they don't directly impact all interest rates. They control what's called the federal funds rate. So remember how I described the central bank as your bank's bank? Well, the federal funds rate is the interest rate that your bank uses when they need to borrow money from other banks or the Fed themselves. And so naturally, if that interest rate that your bank pays goes up, they're likely to increase the interest rates that they charge you on your mortgage or your car loan or your HELOC or what have you. Now, this isn't always the case, to be clear, but generally speaking, that is how the Federal Reserve impacts interest rates. So how do interest rates affect the economy? It's quite simple. When interest rates go up, borrowing money becomes more expensive, which means that the economy gradually slows down. What this does is it reduces inflation, but it can cause unemployment. Conversely, if interest rates go down, the cost of borrowing money also goes down. That speeds up the economy. More people spend, more people borrow, which then lowers unemployment, but it can cause inflation. Now, if you've been paying attention, you may have noticed that the Fed has a bit of a catch-22 because its two goals are somewhat in opposition of one another. If the Fed cuts rates too fast, that could overheat the economy, which would do great things for unemployment, but it would cause a little bit too much inflation. And if the Fed hikes rates too quickly, that could really freeze the economy, which would increase unemployment while tackling inflation. A really simple analogy here is to think of interest rates and the Fed's monetary toolkit in general as a thermostat. You know, when you walk into the room, you set the thermostat, you can turn it up or you can turn it down, and it takes a little bit of time for the temperature in the room or in the house to meet the temperature that you're setting. That is pretty similar to how the Fed's monetary toolkit works, because when they set these interest rates, it takes time for that to work its way through the other interest rates and through the economy. So that's a quick primer of how the Federal Reserve works. They have two goals, which is low unemployment and low inflation. The goals kind of conflict with one another, and one of their biggest tools for this is interest rates. So now we have to talk about their recent rate cut and a little bit of the events leading up to the rate cut. The easiest way to do this is let's pull up a chart and actually look at the federal funds rate and how it has changed over the past few years. When COVID hit in 2020, the stock markets and asset prices tanked. The economy started to freeze up. So what did the Federal Reserve do? They dropped interest rates to virtually zero. They also used a ton of other tools in their toolkit, but we're not going to cover that in today's video. Because they used all of these tools and interest rates were at zero, the economy recovered really, really quickly. The only problem with this, as we discussed earlier, is that has a risk of driving inflation. Inflation went up, and the Fed then had to start hiking rates, and that's why interest rates are as high as they are today. And last but not least, we can see that interest rates have remained largely unchanged. And importantly, from a political lens, Jerome Powell, the chair of the Federal Reserve, has not lowered rates ever since Trump became president once again in 2025. And just to really hammer this point home so you have a full understanding of how the Federal Reserve works and how interest rates work, let's now look at inflation over that same time period. You can see what happened with COVID. Of course, there was a huge spike down because the economy froze up. That's when the Federal Reserve lowered interest rates and did a lot of money printing and used a lot of other tools in their toolkit. Shortly after that, however, that's when we started to see inflation spike up. And many of you likely remember this period when prices were really going up and it was unsustainable. That is when then the Fed stepped in once again and started hiking rates, and that kind of brings us to where we are today. So now with the news this week, interest rates have gone down by 25 basis points, or 0.25%. And the reason I mention this whole Trump thing is because there has been a news story that you might have seen, and hopefully this video helps make sense of that as well, which is there's been a kind of feud between Trump and Jerome Powell, where Trump wants to pressure Jerome Powell to cut rates faster because that would be great for asset prices. And Trump wants to be able to demonstrate, hey, look at the stock market, look at how great the US economy is doing. Jerome Powell, on the other hand, has been saying, well, we're not so sure inflation has been defeated. And if we look at the latest reports on inflation, you can see the Fed's argument where they're saying, hey, inflation might not be down quite enough to justify rate cuts just yet. So what does this mean for you and I as investors? As I described earlier in terms of how interest rates work, generally speaking, when interest rates go down, that is good for the economy and that is good for asset prices. So if you own stocks, if you own real estate, if you own Bitcoin, generally speaking, rate cuts are a great headline to see. However, the reason I say generally speaking is because of a concept we've discussed in a previous video, which is called pricing something in. When something is priced in, that means that investors all across the global economy have already predicted or already generally know that the Federal Reserve is going to cut rates. So to use the thermostat analogy, at this last Fed meeting, Jerome Powell physically turned the dial on the thermostat, but there were a ton of investors that already knew that Jerome Powell was getting up from his seat and walking over to the thermostat, likely to lower interest rates by 25 basis points. And that brings me to what I mentioned at the outset of this video. I'm recording this on September 14th. The Fed meeting where they announced the rate cut is 2 days from now, September 16th and 17th. So how do I know that they're going to cut rates by 25 basis points? And if I'm wrong, you're not going to see this footage. I'm not going to edit this and post it on YouTube. I've said before on this channel, I do not have a crystal ball. I do not make hard predictions, and I certainly don't tell you to invest based on those predictions. However, there are tools that you and I can use to look around the corner in a sense. The first tool is called the Fed futures market. In other words, there is literally a market where sophisticated investors and institutions will trade on the probability of the Fed rate changing in the next meeting. And when I look at the Fed futures market today on September 14th, prior to the meeting, I can see that investors around the world believe that there is a 96% chance that the Fed will cut rates by 25 basis points this week. So that's the first tool. And as mentioned, it's used by traditional finance players like large institutions and sophisticated investors. The second tool is a bit of a newer tool that is used by more modern investors, and that's called predictions markets. Once again, I can look at a prediction market and I can see that investors around the world give it about a 91% chance that the Fed is going to cut rates by 25 basis points. To be super transparent, I am not affiliated with either of these tools. In fact, I don't even bet money on any of these things. The only thing I bet is my time, because if I record this video and I'm wrong and the Fed doesn't cut rates or they cut rates by 50 basis points, then I've wasted all of this footage. But again, because these tools have a 96% and 91% chance respectively that the Fed is going to cut rates, that signals to an investor like me that the rate cut is very likely going to happen, and then I can make movements in my portfolio accordingly. And that is what it means for something to be priced in. Because look, if I can do that, you can bet that hedge funds, mutual funds, family offices, large financial institutions are also doing that. And again, this is why I don't provide specific recommendations based on what could happen. If everybody thinks asset prices are going to go up, then everyone's going to buy assets, and asset prices are going to go up. So that's it for today. If you enjoyed this video, let me know, give me a thumbs up, or if you disagree or if there's questions you have, post in the comments. I'd love to hear from you all. As always, I reply to every single one. And if you like this topic, as mentioned, we will be posting more about the Fed and that third hidden mandate that they have. But you can also check out this video. This is one where I talk about the yield curve. It's a very important concept when it comes to interest rates, in particular, how that federal funds rate that all of your banks use impacts all of the other interest rates in the economy. Once again, thanks for watching, and I'll see you next time.